Hey everybody, welcome to your weekend review for the week of Monday, May 29th, 2023. And oh, what a week it was. Week started off pretty fabulous for me. It was Memorial Day and I actually woke up down in Waikiki, Hawaii, and I started out my morning with a really nice walk. We're walking out, had beautiful views of Diamond Head and the beaches, but as I walked back, I couldn't help but think about the fact that I was facing towards Pearl Harbor, and there was a day really not that long ago when these skies looked a whole lot different and people were taking off out of that area as teenagers that had way bigger concerns than whether or not there was Wi-Fi on their flight. So a special thank you to everybody who served. Tuesday, which is today, brought us back into the bond market. MBS were up 31 basis points in the morning, stocks up 10 points. Bonds opened slightly stronger in Asia as Friday failed to yield a debt ceiling resolution. Other contributors included friendly comments from the Bank of Japan and Ukraine war escalation. Gains continued in Europe as the average economic report came out slightly weaker than usual. Month-over-month home prices and year-over-year came in. We got the FHFA and Shiller today. So Shiller came in up 0.5% on a 0.0 forecast. It was 0.3 previously. FHFA, which is smaller loan amounts, typically is 0.6 on a 0.2 forecast. It was 0.5 previously. Year-over-year home price changes. Shiller was down 1.1% versus a negative 1.7 forecast. FHFA came in up 3.6% versus a 4.0 previous. Fastest growing states were South Carolina, North Carolina, Maine, Vermont, and Arkansas. North Carolina's appreciation has been going for a while, but the other states are new to the leaderboard. Declining states include Utah, Nevada, California, and Washington, D.C. Further west we look, the weaker the pictures are. Seattle was down 12.4%, now leading San Francisco, which is down to 11.2% at the bottom of the league table. It's hard to comprehend this number, but home prices nationwide have risen year over year for 45 consecutive quarters, according to the FHFA Housing Price Index. The White House and House Republicans reached a tentative agreement to raise the nation's debt ceiling. Negotiators announced over the holiday weekend the deal, which now must be passed by the Republican-led House and Democrat-led Senate, comes ahead of an updated deadline of June 5th. According to reports, the agreement will raise the debt ceiling for 2 years, pushing the issue past the 2024 presidential election. Non-military discretionary spending would remain flat for fiscal year 2024 with a 1% increase the following year. Military spending would increase 3% in 2024. The week ahead will be dominated by the jobs report on Friday. We will also get home prices, which we got today, productivity and ISM data. This will be the last job reports for the mid-June FOMC meeting. The Fed Fund futures are currently see a 60% chance of another 25 basis point hike, and that's hot on the heels of there being major bets that there would actually be a cut then. Consumer confidence also declined in May, according to the Conference Board. The assessment of current employment conditions saw the most significant deterioration, with a proportion of consumers reporting jobs as plentiful, falling 4 percentage points from 47.5% in April to 43.5% in May. Consumers also saw a more downbeat about future economic conditions, and their inflationary expectations remain high, with consumers expecting 6.1% inflation over the next 12 months. Anytime bonds make a big but not necessarily completely justified move in a run-up to a 3.5-day weekend, we're inclined to suspect a certain degree of precision squaring. In other words, traders who have been betting on an intact trading range sold bonds and pushed rates higher. While that may not be the only way to explain these losses seen last week, the return of buyers does explain a bit of Tuesday's bounce back. Other factors include European bond market strength and the debt ceiling delays. At the end of the day, we were up 44 basis points at 99.5, so still below par. The 10-year was down 8 basis points, and the stocks were basically flat. So at 99.5, we're right in the middle of this very wide range, where we have a Fibonacci retracement at 99.845, and then another one down at 98.938 with these kind of wide 98.938. With these wider ranges, it can get a little bouncy, and we don't have significant stuff until coming later in the week. We also got news that JP Morgan Chase plans to cut 15% of the staff, about 1,000 people at First Republic Bank, which it acquired after the seizure by the federal regulators earlier this month.